The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen. Thank you for being with us for this webinar from the Daniel Code. And good morning to our friends in Australia, and good afternoon to our friends in New Zealand. Rob H. is with us. Rob, you're now living in the socialist capital of the South Pacific. New government in New Zealand, which I'll tell you about a bit later on. It's weird times, isn't it, folks? Some of the equities are charging to new highs. Russell doesn't want to go there. Rob, so embarrassed I don't want to mention it. Well, look, at least she's a good sort, mate. I mean, that's usually half the battle. Folks, I guess you can all hear me all right. Rob's already kindly responded to me. Just type into the questions box if you can hear me all right, would you please, some of you? No? Yes, we've got some here. Rose is good, yes. And Suhasini, yes, thank you. And Jeremy. Jeremy's in the UK in the middle of doing his tutorial. Thank you, guys. Michael, you down there. Justin Woolley, good to have all of you with us. And John down at Coffs Harbour. Yeah, good to have you here, folks. Okay, I want to show you something I hope a bit interesting and a bit offbeat today, which is designed as always to make your trading better and to show you the possibilities of trading futures. So let's move along. Our fourth seal analyst, Frank de Beer, has done a most important article for you. It's called Vienne la Tormenta 2. And he's talking about the equity markets, particularly the DAX, and its relation to the US markets. And he also has a good slather at gold as well, because I know that's what brings the crowds, the gold bugs. So he probably put something in for you lot. Harold, the king of the gold bugs, is with us from Reading today. Nice to have you with us, mate. So most of you, if you're on our mailing list, you've already had an email from Terry telling you about Frank's new article. He doesn't write for us very often. He's a very, very busy young man. He does most of the fourth seal analysis for us, and he also runs a working farm in Belgium. Very busy young man with a young family, so we don't hear from him often enough. And it's a very, very important, might be a very important article. I do suggest you read it. It's on the front page of the Daniel Code website, www.thedanielcode.com. And thank you for that, Frank. I know you'll be sleeping now. It's early hours of the morning in Europe, and must be very, very early for you in London, Jeremy. Goodness, endorse it. Wow. Anyway, Frank will see this later. So, Frank, we appreciate it. Most grateful. Okay, let's move on to what I want to talk to you about today, folks. Chris has just joined us. Hello, mate. He's a tutorial guy. Lots of them are. This is a quote, one of the quotes from Jesse, from the book Reminiscences of a Stock Operator. Jesse Livingston wasn't his real name. A mammoth trader, huge bear, made and lost fortunes in the market, particularly the 1907 crash and the 1929 crash. But there's an interesting part in here that I always keep in mind. And you'll see at the end of the first paragraph, or the whole of the first paragraph, people basically acted and reacted the same way in the market as a result of greed, fear, ignorance, and hope. That is why the numerical formations and patterns recur on a constant basis. If you move further down, the game of speculation is the most uniformly fascinating game in the world. It is not a game for the stupid, the mentally lazy, the person of inferior emotional balance, or the get-rich-quick adventurer. They will die poor, as in fact Jesse did. He finished up blowing his brains out after losing about his third or fourth fortune. There we are. That's life in the trading channel if you don't get it right. And of course, Jesse finished up breaking all his own rules, which is why he finished up in that bad position. So what I want to do today is show you Uh, what you can do to enhance your trading, and the most important thing in trading is trend. I've been banging on about this for the last few webinars, talking mainly about the smaller trends. And numbers and patterns are the precursor to trends. One of the interesting things that's not generally recognized is that big consolidations, multi-week consolidations, are very often turning points that will trigger a fast trend for a considerable time. You can see this particularly in oil. Go back a few years in oil and you'll see big consolidations at the highs and the lows, then leading to very dominant trending periods. So this is something certainly worth keeping an eye up. And trends happen in different time frames. There's usually more than one trend in place. So you can often have a dominant trend. You might have a dominant downtrend. And that's punctuated with counter trends, which appear on the daily charts or smaller time periods. And I've left you with two thoughts at the end of this. The trend is your friend. We all know that. And the other one is, as we see at the moment, markets can stay overbought much longer than you can remain solvent. Sister Sage and Mustang Man have arrived. Hello, folks. The new arrivals at the webinar from the Communist Centre of the Socialist Centre, I should say, of the South Pacific. God, what a shame. Yes, I guess the Kiwis just couldn't really stand 10 years of good government. They've had a wonderful trot under John Key and Bill English, and this stupid hello from Harvey Weinstein. Yeah, good day. This ridiculous electoral system they have that they invented in Europe. Good argument, folks. Stop your public servants from travelling. You know, they flit all over the world, and some of them go to Europe, and a lot of them go to California, and they pick up these ideas and bring them back home and infect all of us with them. So the National Party should have won in a landslide in New Zealand. First past the post, which we don't have either in New Zealand or Australia. And so the kingmaker with about 3% of the vote managed to determine which of the major parties would become government. Quite wrong. Okay, let's move on. There's Daryl Scudder. I bet he is. Horrible, isn't it? Anyway, we'll see what happens. Let's move on. Let's have a look at what I'm trying to get to today with you folks. Real insights into how markets work and why they do what they do comes from concentrated observation and study. Take a hypothesis and try to prove or discount it. This is how you learn about markets. I mean, I have spent so many hours just looking at charts. You're not going to believe it, but you know, it's that constant observation and asking why is it so that gives you the insights into markets. And the more you can develop those insights, the better trader you're going to be. And folks, it's really, really worthwhile being a very, very good trader at futures. There is nothing I know of that you can make more money in legally. If you're an absolute top trader in futures, the returns are magnificent. I was talking to Manish in India yesterday, one of our latest tutorial guys, and the numbers he's turning over in paper trading. Indian futures, they can't trade US futures. They have their own futures markets. It's quite extraordinary, the difference in gearing with some of their markets, particularly gold. Any of you gold bugs, you want to have a look at the gold futures contract in India. The gearing looks to be pretty sensational. But, you know, this is an endeavor that's worth putting a lot of work into. And as Jesse said, as an intellectual exercise, understanding what markets do and why they do it is a lifetime pursuit, but it's very, very rewarding. You know, I'm totally passionate about markets. If I'm on holidays, which doesn't happen very often, as you know, folks, we try to have off 1 week every quarter to, you know, have a break from trading and catch up with the domestic chores and what have you. Well, you know, we're into mid-October. We haven't had a week off this year. We haven't had a break since last Christmas. So the market has just been too good. It's too fascinating. I can't stop. So after all these years, I'm still an addict. Look, we've got some more people who have arrived here. Just bear with me for a moment while I greet some of our old friends. Adrian, haven't seen you for a long time. Probably got the baby now. Alan down in Florida, he's doing a tutorial. Albert, he's thinking of it, of a tutorial. We've got Alex with us. That's great. Chase, my smoking nemesis, Chase. I am determined to cut down on smoking as a first step, and I'll tell you how that story goes. But thank you for keep hassling me. Chris Amon, he's a tutorial guy in the middle of his tutorials. A few Darrens, my friend Daryl over at, don't know if you're still in Mossman, Daryl, but good to hear from you, mate. The other Daryl down in Wellington, Webby, the king of the black lines, Donnie Maydell up in Canada, Harold Foos, the king of the gold bugs in Redding, California. Mr. Nguyen, I can't remember his first name. He's a new student. Hugh Sinclair, glad to have you back with us, Hugh. Janet Christopherson. I always have a particular wish to say hello to the ladies. We still don't have a lot of them. Oh, yeah, Daryl's still in Mossman. That's great. Jen Yu, not sure if that's a lady or not, but nice to have you with us. Jeremy in Dorset, England. Johnny L down in Coffs. The Woolly Boys down in the Hunter Valley. Mark, the other Mark's doing a tutorial, and talk about him later, in fact soon. Michael Peel, thank you Michael for being with us wherever in the world you are, a great traveller. Mike Murphy, the tutorial guy, Mr. Deck, haven't seen him for a while. Philip, Pierre, Rob H, of course, in New Zealand. Rose, nice to have you with us, Rose. Hope your trading's going great. It was nice talking to you earlier this week. Terry, haven't seen you for a while. Terry, Robert down in Melbourne, great to have you with us. Tom in Florida. And Vicky, whoever you are, Vicky Butterworth, how lovely to have you with us. What a delight, thank you, and Bill Ford as well, all our usual friends. Great to have you all with us, folks, and all the ones that I haven't greeted. I do greet you. So let's go back to where we were. So thinking about your trading and focusing on profit opportunities, the method I use is to use mechanical systems to test various propositions that I'm interested in. Now, I spent years and years doing it by eye, by hand, and the eye lies. It's very easy to say, oh, yeah, look, I got that trade. You know, you sort of, you have bias, and that bias is usually better than reality. So the most effective way to measure a system, and don't forget we haven't even reached the state of talking about optimizing. We're just measuring with a mechanical system. Is I use a system that it is okay. It's good. It's very good. Some people would think it's great. I think it always needs improvement, but it's the same system. So with a push of a button, I can test any market over a reasonable period of time. And the beautiful thing about a mechanical trading system is you can get over long enough periods of time for it to mean something. I'm trying to find where my little tools have gone down here, but they've disappeared. Anyway, let's have a look what I'm talking about, see if we can get this thing to change, and we have. So for this particular exercise, we're going to look at oil today. Oil's been a very dynamic market all this year. That's led to the correlated markets, gasoline, heating oil, natural gas, all being pretty dynamic as well. And this is a machine test that runs inside Trade Navigator of oil. This is the 067 continuous contract, which is what the machine programs run on. That's just a code for one of Trade Navigator's continuous programs. This one happens to be back adjusted, so it gets rid of the premiums and discounts on rollover. All these energy markets, incidentally, if you don't trade them, they have a rollover every month. In fact, talking to Manish, the Indian markets, their futures all roll over on the 30th of the month, regardless. They don't have any futures markets that run on seasonality like our grain markets and gold and others do. They all finish on the 30th of the month. But all the energy markets roll over every month, so there's a lot of rollovers. If you use the 067 contract, the back adjusted contract, that gets rid of the premium and discounts if you're machine testing this stuff. And you can see this is a nice program, makes a lot of money. It's nowhere near fully optimized. The winning percentage is only 53%, which is just barely acceptable. But as you can see, it's made $20,000 year to date on one crude oil futures contract. And that's pretty nice. And you can see that it says in prominent block letters in the third line, no stops. I don't use stops when I'm testing because there are so many different types of stops that we could use, and they just bring another variable into the equation, which makes things much harder to analyze. So if we look at oil just on this particular model, which is a better than average one, look at the money it's made, but it's got lots of other things could be improved, but it does the job simply because it's mechanical. It doesn't have a view. It simply repeats the rules that it has day after day after day. And it's made 20,000 in 10.5 months on one oil contract. Okay, let's have a look at some observations about that. Starts with, don't freak about the drawdowns. Everyone always focuses on the drawdowns because I guess their experience is that they have a lot of drawdowns. You shouldn't have big drawdowns. If you have big drawdowns, your stop loss management is faulty and or the program's a total bust. There are, of course, when we're actually trading, we will add stops. There are no orders without stops. Every order has an accompanying stop loss. Now, the margin for crude oil is 2,475 at the moment. These margins vary a little bit around the place, but that's what it is on Gain Capital right at the moment. So part of what this program does is it calculates the account size required if you want to trade this market. And this particular one says about $8,500. That's because there are no stops in this program. With stops, that account size required should be no more than margin, $2,475, say $2,500 for 98% of your trades. And yes, I know you don't get stopped out exactly where your stop is, and I know all sorts of gaps and slippage and everything else can happen, but they don't happen very often in these sophisticated continuous trading markets. This continuous electronic trading is actually a huge boon for traders. You have a look at the markets that don't have 24-hour trading. Last session we had of a webinar, we looked at the Hang Seng in Hong Kong, and I think we looked at the China market as well that just still trades on regular trading hours, and basically that's hopeless. If markets are a discounting mechanism, the more they can respond to data as it happens, the more accurate they will be. And, you know, we don't have any great big catastrophe things in the bigger future markets these days, except very, very rarely. I remember in the crash, the 2000 crash, I had a bunch of young brokers in Chicago who were following my trades, and I told them what I'm telling you, that when you put your order on, every order has a stop that goes with it. And they wouldn't do that. They said, oh, well, you know, we're brokers and we've got our mates on the floor. They had floor trading back in the day. We've got a priority line. Our orders will get filled before anyone else in the pit. And we don't put our orders on because we can do it almost instantly if we ever feel we need to. 2000 was running with plenty of downside drama, and the government, trying to remember who the Fed was. Was it Bernanke at the time? I'm not sure. They were trying desperately to stop the markets going down. Feds don't like markets going down. Fed like markets going up all the time, which is why they're juicing them all the time. Excuse me. Very good coffee this morning. Coffee is always good. So what the Fed did is, in the middle of trading, during a trading session, unheard of, at about 11 o'clock in the morning, the S&Ps were diving for the floor, and he came out in the middle of a trading session and announced a huge interest rate cut. And the market just reversed and gapped and just took off like a scalded cat. And these guys, by the time they thought they could get their stops on, and they certainly had Greenspan, that's it, Scott, thank you very much. They thought they had priority to everyone else because, they were brokers. Their mate was handling the floor and had this direct line. Anyway, long and the short of it, by the time their stop got executed, they had 27-point slippage, and I don't mean ticks, I mean points. We were trading the big S&P in those days with about a $22,000 margin, and oh boy, they had a serious long-term pain from that. So remember, there's no order without a stop. Now, for you, Mark, and some of you others who are thinking about, who are worrying about bad fills, you can use a stop limit order for your new order, your new position order. You must not do that for a stops order. Your protective stop must be on stop. Even if the market gaps past you, you want to be filled. If the trade has gone past the failure point, you want to be filled and out, no matter how badly, because one day the same thing as Mr. Greenspan did will happen. And if your stop is not on and on stop, you're not going to get filled. Okay, always calculate your returns percentage of margin. I know other people don't do this. Most people like to talk about their returns, a percentage of funds available, funds they've got in their account. But the reality is, when you put on a trade, margin is deducted from your account. That money's gone. The opportunity cost of that money is gone. It's zero. If you're managing your stops properly and you're an effective risk manager, you won't have much more money in your account than you require for your trading. Now, it doesn't matter so much today because interest rates are just so lousy, they don't really matter. But interest rates one day will come back to being worthwhile. Back in the day when interest rates were, 7, 8, 9%, on call money, and mortgage rates went to 14%. I don't think it can happen again, but never say never. The importance of having your interest component of your trading account was just so big that we had arrangements with brokers that anything excess, apart from our open positions and the margin plus a small buffer, was just swept off to the call account every afternoon. But that's the real way that's the way I calculate return, because that's what when you have a trade, you put up margin. That's what's at risk. If your stop is any bigger than margin, you're a pretty sloppy trader. My stops are never as big as margin, and yours shouldn't be either. So that's what you've really got at risk. And once you entered a trade, the margin's out of your account, so the opportunity of that has gone. First thing to look for when you're trying to produce a hypothesis, look at the obvious stuff. Don't worry about the technical stuff right at the beginning. Look at the obvious stuff. This is a analysis of that trading crude oil year to date, 2017 year to date. And you can see, have a look at the results by weekday. Monday, 8,900 from Monday trading, 71% win. 7,500 on Tuesday, 53% win. 6,000 odd on Wednesday, 50% win. No profit on Thursday, and almost $3,000 loss trading on Fridays, with the win rate down to 37.5%. So there is a clear bias of this nature. This is sort of a subset of the seasonal bias, if you like. There is a clear bias of this nature that happens in many markets, not all, but certainly I'd say most. And this can change. Don't pin your backside on it. Just because Friday is a bad trading day for oil in 2017 doesn't matter. It doesn't mean that bias will continue. bias is like volatility. It comes and it goes. You need to know when it comes, ride the wave, and be prepared that the wave doesn't last forever. So we've done our year-to-date analysis on oil. We've got our 10.5 months, 9.5 months trading, I should say. So let's break that down to see the mechanics. I start by doing a month-to-month analysis, and then I use a trailing 4-week and 6-week sample. In other words, I don't assume that the bias happens on a calendar monthly basis. That's the quickest and easiest way to get a snapshot of what markets are doing. But if you use a trailing 4-week, it will overcome that issue of monthly bias, because there's not an essential monthly bias in markets per se. There are patterns in markets. October is often considered a weak month, etc., etc. Oil, for example, has been weak in January and February for a couple of years now. But you can see that sample size, or you're about to see, sample size is a vital consideration. But so is mechanical testing. The eye is easy to deceive. Mechanical programs don't lie. And, if you're testing by eyeball, trying to find things that markets do, trying to understand why markets do what they do, your own inherent bias will make those numbers better than they actually are. You really need to have the basis of mechanical program to do this sort of testing. So to shortcut this, instead of going through every month and then doing the trailing 4 and 6 weeks, let's just look at January and February 2017 in oil. This is just the same program, again, no stops, and have a look what happened in January and February. You had 13 trades, lost $2,500. That includes commission. These programs allow for commission because that's a real expense. Your win percent is down to 38%. This is nearly as bad as trading on Friday. In fact, January and February sort of suggest to you that every day was Friday, and that's very, very poor. So about this stage, most people would say, yikes, disaster has struck. The win rate for January and February is unacceptably low. We've lost money, not promising. We're tempted to bin this market. But relate what's happening in the mechanical trading to the chart to see what is happening. If you do that with oil, you do this with every market, the price action is striking. We have a giant consolidation running. So the market is not trending. The point to remember here, worth going back through oil for a few years and see these big consolidations that oil habitually makes. They all lead to fast trending markets after they've broken from the consolidation. So certainly not a bad search criteria, something I'm looking for all the time. We have a big, multi-week consolidation. I'm looking at that market when it breaks out to give me a really good period of trending markets. So the trending markets we need, because that's where we make the money. This is the oil chart, and you can see in red, I've highlighted for you January and February. So there's 2 good sell trades in there, and there's 2 good buy trades in there. And that's all. The rest of it's up, down, inside bars, outside bars, choppy. Bias is up, a couple of big pullbacks. That's not the sort of trading that's going to build a big equity curve for you. But look what happens when that consolidation breaks. You get this beautiful trending market, and this is the best sort of trending. The sort of trending we get in the equities, that they're up, day after day after day, is not a good trading market. It's great for investors who don't know about trading. They buy and hold. That's exactly what they're praying for. It's marvelous for them. It's not good for traders. Because there's always enough of a move to just tip you out, and you're continually going back in long, and there's not enough volatility to push the markets away. The very best markets to trade are markets doing what you see on the right-hand side of this screen here. Up, down, up, down. We get paid exactly the same going down as we do going up, so don't be frightened of that. In fact, it's better because generally it goes down faster than it goes up, and be very wary of equities types markets that don't have enough volatility in them. I love the pullbacks and then the roar up and the pullback. That's trading heaven for us. This continuous up, 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 up. Horrible. Horrible. Okay, so that's what was happening in January and February. And if you saw that and your testing was telling you this is not good trading, in fact, your results would be showing you that, because in that whole 2-month period, you've actually got 2 good sell trades and 2 good buy trades. You would be inclined to say, this is not a great market to be trading, I'm going to get out of it. Watch it. Have a look, understand why it's doing it. You look at the chart, the first thing you say is, oh, this is a big consolidation. That makes trading pretty difficult. If you know what you're doing, you can go to safety mode. You can still make money, but you're not getting that big equity boost in that sort of a market. Okay, but then watch for the breakout. Once this gets out of its range or gives you a decent breakout, that will almost certainly, after that period of consolidation, 2 months, the probability is, remember, everything we do in trading is just probability. There are no certainties, just as there are no certainties in life. But by using a proper trading system, we refine those probabilities so that they are hugely on our side. Okay, which brings me to our next page. Before I explain to you what you're looking at here, I want to tell you a story about my magic people. One of them is Rose, who's with us today. Another one is Mark, who's with us today. Now we're doing a little bit of a trading experiment with him. He's getting near the end of his tutorial. And the other is Manish, that I've just done a tutorial with in India. He's a bit more than halfway through his. And in talking to those people this week, they've all said, in essence, they've all said the same thing. How do you know what this market's going to do tomorrow? Now, that comment is sometimes phrased different ways, like, how do you know when to take profits? Or, I thought this market was going to turn. I assumed this market was going to turn. And what I've said to all of them, and I say to you, we don't have the gift of foresight. We have no idea what's going to happen with the market today, tomorrow. I have no idea, nor does anyone else. Anyone who tells you they do is a liar, okay? We as human beings do not have the gift of foresight. But the good thing is, for trading, we don't need it. With the Daniel Code trading systems, whenever a daily bar is completed, we can quantify and qualify that bar, and we can identify the rule that says, if the market's done that, then you do this. And the you do this might be put on a new order, or it might be adjust your stop, or it might be something else. But the Daniel Code is a completely rules-based system. You don't have to even guess what's going to happen tomorrow, because if you think you've got an idea, that's bias, and that'll ruin your trading. So forget that idea. Go and get a long piece of sticky tape, write on it backwards the way Leonardo da Vinci did. I do not know what markets will do tomorrow. Then stick it across your forehead so that every time you look in the mirror, you'll see it. Maybe we can get that idea through. You don't know what the markets will do tomorrow. I don't know what the markets will do tomorrow. We don't need to know. We need to know what the market did today, and that will fit into one of the Daniel Code signals to either create a new order or adjust our stop, or perhaps both. From that point on, we let the market decide, because we've refined this thing so well that we have got the probabilities hugely in our favor. Okay, so those my little 3 magic people I spoke to this week, all were fretting over the same thing. What's the market going to do tomorrow? It doesn't matter what the market's going to do tomorrow, because if you're doing your Daniel Code trading properly, folks, what the market's going to do tomorrow is reward you. That's what markets are here for. Give you the gift. Lots of lolly. That's what happens. Okay, so what I'm showing you here is a different way that you may not be aware of finding trend. And this is a rather old-fashioned notion called an overbalance of time and price. And basically you can see on the tops of this chart, I've got two bars with have an arrow to them saying over balance of price. That means the price in that bar, the downward move in those two bars, whether you take it high to low or whether you take it open close, is bigger than any bar in the previous move. So you're comparing that bar against any down bar in the previous rally, and you've got an overbalance of price. Prices move further than at any time in the previous rally. That's called an overbalance of price. This actually led to a theory called zero balance point, something like that. Used to be very big in the 70s. I haven't heard anyone talk about it for years, but the basic concept is this idea of overbalance of price, which you will often see at a change of trend. In fact, over here, I'll just get my highlighter so you can see where I've spotlight it's called. You can see this bar here. You've had an uptrend through here. You see this bar here is the big bar down, overbalance of price. Okay, when we get here, this is the same, overbalance of price. These are very, very strong clues for a change of trend. This is not by any means the best way to do it. We have much better ways of doing it and faster ways, but some of them overlap with this method, and this is something you should certainly consider. We had an overbalance of price at this May the 5th low. The other way, this was an overbalance up. If you look at the length of this bar, high to low, and also its open-close relationship, this is the highest up bar that we've had in this whole rundown from April the 19th. That's the overbalance of price that turns the trend up. Down on the right-hand side here, I've given you an example of overbalance of time and price. And this is a method used by stock traders. A lot of the hedge funds use this method to calculate their stops. And basically what I've done here is I've taken this rally from this low up to this high, and I've projected it from this low. In other words, I'm looking for a rally that's bigger than the previous rally in all this rundown. And that's why it says 1. That's 1 times, that's equal to this rally from this low up to this high. And many stocks traders and hedge funds, prop traders, etc., use this method for their stops, their stop losses, particularly in markets that are sort of trending semi-continuously like the equities do most of the time. So that's an overbalance of time and price. You've not only had a bigger up move than at any time since May the 25th, you've also had an overbalance in time because you've now got 1, 2, 3, 4 bars up, which doesn't appear anywhere else. In fact, in this whole rundown from May the 25th to this low here, which is 626, I think, look at this. 1 bar counter trend, 1 bar counter trend, 1 bar counter trend, 1 bar counter trend. You've had 4 counter trends in this big move down, and they've all been of 1 bar. Why is that? Well, in a trending market, markets will only correct 1 to 3 bars. Markets will not correct more than 3 bars in a true trending market. Okay, so that's how you can see overbalance of price and time, and do some work on that. It's a very cool aid to telling time and price. There's an example of overbalance of price changing the trend, and an overbalance of time and price also changing the trend. So let's look at this big rundown. We're drilling down. We're trying to understand the entrails of this market and some of the things it's doing. So let's have a look at this big rundown. This is May 25th to June 21 this year, 2017. And let's, that looks like a great trading opportunity. It's a big, long rundown. Yes, it's punctuated by counter trends. Most moves are. Getting a non-stop run up without a counter trend is very rare. That's why this is such a valuable trade here. 1, 2, 3, 4, 5, 6, 7 bars straight up, no counter trend. Wonderful. So this is this big move down, and let's see what that means to us in terms of trading. And here we are. And what we've done is we've used exactly the same model. Again, no stops. And that great big move down only finishes up giving us $1,870. And there are 8 trades, but 50% of them are losing trades. And why is that? Because they're counter trends in a strong trend, and in a strong trend, counter trends by definition fail. So the subject of this webinar today is trends and stops and market selection. Okay, so knowing the trend is one thing, then acting on it is the next thing. So here's what appears to be a really nice move, and it finished up being not much, $1,800 from 8 trades, pretty ordinary, 50% win, nothing special. So let's see what happens. The logical thing to do would be to say we have a overbalance of price. We soon after that get an overbalance of time. Trend is down, looks like a trending market. If it's a trending market, it won't correct more than 3 days. So let's just take short entries only. This is exactly the same program. It's giving you just the mechanical result. If we take the short trades only and we design our stop, remember what I've said to you, in a trending market, markets will not correct more than 3 days. That means in a trending market, we should be able to use a 3-bar trailing stop. Okay, which means that your stop loss will be above the highest high of the last 3 completed bars. If we do that in this period, we get 1 trade. We get $7,900 from 1 trade. In other words, we get the lot. Okay, this is not in the results I showed you at the beginning. The results I showed you at the beginning is trading both ways, long and short. What I'm trying to alert you to now is if you can identify a trending market and you optimize your trades either completely as I've done, say take the short trades only, or bias your trades so you're having bigger trades with the trend and smaller trades against the trend, which I don't recommend, or alternately, have your stops in the correct place, that you're following your 3-bar trailing stop, your 2-bar trailing stop, whatever you're comfortable with, when you're with the trend. And if you're taking a trade that you think is a counter trend, be far more aggressive on your stops. And look at the difference it's made. Let me take you back to what we got. This is the previous result summary. This is the same piece of chart. You can see the dates up here. This is 525 to 626. Okay, you got $1,800 at a 50% win. This is exactly the same. This is 525 to 626. The only difference is we've taken short entries only, and we've got a 3-bar trail as our stop. That's jumped to $8,000. 1 trade. And boy, does that make a difference to your equity curve. It certainly does. Okay, this is just to show you the time signals. I'm always very excited about trading time. Every one of these turns and trend changes has an accompanying time signal, which really gives me and anyone using Daniel Code, trading Daniel Code time, huge confidence that you'll be able to see where the potential turns are. And this is faster than over balance of time, any of that, because you're actually in the trades when the market turns. Okay, so we drilled down to the May 25th to June the 26th downtrend. Trading this section of the chart returned $1,870 from 8 trades trading both ways. That's long and short on the model. Now, that's the default way that most of you trade. But if we'd recognized the trend change on the 525 bar, and there were a number of ways to do that, we could optimize to just take the sell side trades, or we could optimize our stop loss management to bias our market results towards letting the market run when we're with the trend, being more aggressive with stops when we're against the trend. And if we could recognize a trending market, we could use a 3-bar trailing stop, which is what we used on that big rundown, because it seemed to me the market was trending, and in a trending market, we know markets won't correct more than 3 bars. Don't try this unless you are a highly competent trader who can recognize trend changes very early. If you've done a Daniel Code tutorial, you should be able to understand what I'm talking about. If you haven't, don't go to a 2 or 3 bar stop unless you're really sure that you can recognize the difference between a counter trend and a change of trend. And you ought to be able to recognize that with a better than 85, 87% probability the day the bar ends. Okay, not all of them are as big as those ones we saw, those huge outside down bars, but you should be able to recognize them on the day the trend changes. John from Cops has asked me, use of this trading stop means we don't take time signals against the trend, e.g. buys in the case of the oil run down. Well, John, you can do whatever you like. It's your money. I've just taught you how to trade. And I've said that one of the alternatives is you just take the trade with the trend. The other alternative is, as I have taught you, is that you bias your risk management so there's less risk if you think you're entering into what appears at that stage to be a counter trend trade. And you can do that so that if you use a smaller stop and make it a trailing stop, it'll move up as these counter trends move, and you don't lose very much money on the counter trends at all. The way I did it, I didn't lose any money. I got that whole run down by using a 3-bar stop. But that's a fairly aggressive strategy, which is why I've got this sentence underlined. Don't try this unless you're a highly competent trader who can recognize trend changes very early. By that I mean on the day they happen. Okay, but by that particular strategy, and there's many ways of trading. That's not the only way. You could have used all sorts of strategies, but I'm making the example, so I'm showing you the most extreme interpretation to make the point that made almost $8,000 in one trade. Remember, with anything that I'm talking to you about, there are often just very subtle variances in the results you get by using different strategies, but I will always tend to use the most extreme example I can find because I'm trying to make the point to you. That simple change in strategy, understanding what the trend was, taking advantage of the probability there's a strong trend in place, and using stop loss management, the things that this webinar is about, have turned 1,800 profit from 8 trades into $8,000 profit from one trade. Okay, but this isn't the only way. Inside there's all sorts of subtle variations and different ways you can do it. But selecting trending markets and optimizing the stop loss program is central to enhanced profitability. Okay, if you want to be a super trader, folks, if you send me an email, jneedham@thedanielcode.com, let me have your phone number and country so I know what your time zone is. I don't call you in the middle of the night. I'll call you and discuss your trading and how you can take a Daniel Code video tutorial, which will take your trading to the next level. Very interesting. I've had a chance to talk to a number of people lately, and there's just so much interest and excitement about becoming an elite trader. You'll need determination and dedication. The rest I'll teach you. Okay, here's the news from New Zealand, folks. This pretty lady here with a mouthful of teeth is Jacinda Ardern. She's 37 years old. She's the youngest Prime Minister of New Zealand in 150 years. And it's an extraordinary tale. She's a girl who's worked all her life in politics. She's worked for Blair. She worked for Helen Clark, the socialist, well-known socialist. Like Helen Clark, she's never held a job in her life. Her whole life has been in the Labour movement and then into politics. And she's been a backbencher for 10 years and no one's ever heard of her. 6 weeks before the New Zealand election, the leader of the Labour Party, the polling was so bad, he just resigned. He said, it's hopeless. No hope for the party, no hope for me. I can't get the party back to where it was. So they got this little, not little, I mean, she's 37 years of age, this charming young lady, Jacinda, and said, righto, you're the next leader of the Labour Party. No policy, no experience, nothing, but very, very photogenic. And, to see her on video and newsreels, a charming person, a real down-to-earth Kiwi. And that's all it took. This is the era of Trump and celebrities. And because this girl is so different to our usual, not terribly attractive looking old, elderly white male politicians or frumpy, large female politicians, the media went nuts over. And so did the electorate. She took Labor from nowhere to be leading National, the governing coalition, in the polls. For you Americans, Labor is Democrats. That's the party of the trade unions, and National Party or Liberal in Australia is not Liberal. It's the opposite. The National Party is the Farmers' Party that works with the Liberals, which is a Conservative Party equivalent of your Republicans. So simply by being so photogenic and nice person, she actually had the Labor Party leading the ruling coalition, which has given New Zealand 3 terms or 2.5 terms of wonderful, stable government, economically done very, very well. None of that mattered. This lady was just going great until she let the socialist genie out of the bottle, talking about a capital gains tax on homes, taxing water for farmers, taxing anything. That's what Labor does. If it's not nailed down, they'll tax it. Extraordinary thing that we have this silly thing called MMP that it works in the electoral system to avoid first past the post voting. Parties have to form coalitions. The National Party had the highest vote. Everyone assumed the minor rump party, New Zealand First, which is really just a cranky old man's joke. Winston get a bit of spotlight on himself. He should have, convention said he dealt with National. He didn't. He decided to throw his, they only won 1 seat in Parliament. They got 4 or 5 people in on this MMP basis. They decided to join with Labor. So this, folks, is New Zealand's new Prime Minister. And I know that's of no interest to those of you who don't live in New Zealand, but there's been an awful lot of New Zealanders, very, very wealthy New Zealanders, buying properties for massive amounts of money in New Zealand, thinking it was a bolt hole to escape from the feared ravages of Trump. Peter Thiel and a lot of those sorts of guys have bought huge multi-million-dollar properties in New Zealand. In fact, that's not going to be the case. You're not going to be able to allow land allowed to buy land. Foreigners are not going to be allowed to buy land in New Zealand. At least they're going to cut down on the immigration, which is absolutely out of control there. Australia, New Zealand, immigration is just a joke. They're ruining the country. Rob's my source of all sorts of things in New Zealand. Her only job was as a fish and chip vendor. Personality politics New Zealand. Smile, do your hair, and you're in like Flynn. The young all jump for today's news release. Out from this new government is there will be a referendum on personal cannabis use. Headline news. Wow. I mean, anyway, that's what happens. Figure the Democrats in the States will run Clooney and Oprah, probably win the next election. So I thought you'd like to see the lovely Miss Arden and the little chart on the right is our sell signal for New Zealand Japanese yen today. Wasn't easy because it got elected yesterday, and today it made a higher high and hit the stops. You had to be pretty aggressive to get back into it. But if you did, there's some part of $1,000 from that TO3 sell signal. And I hope you got it and that it was all good, folks. Okay, Jeremy. Let me see, have we finished this part of the presentation? Free trials, folks, if you haven't done so already, go to the Daniel Code website, click on the free trials button, follow the prompts. We'll be happy to extend you a 31-day free trial of everything that's on the website. And if you haven't yet used Genesis Trade Navigator, we are one of their partners, and we can arrange a free trial of that trading software for you. Any problems at all, let Terry know at Daniel Code support at thedanielcode.com, and he'll be happy to assist you. He's a very good bloke. Here's our compliance statement, and I always like you to be aware that trading is risky. If you haven't learned how to trade the Daniel Code way, it's very, very risky. So be careful, folks. It's a two-edged sword unless you really know what you're doing. If you'd like to learn to trade, I'll be more than happy to teach you. Okie doke, here we are. What have we got next? Let's have a look. Not much. Yeah, there's the, this is New Zealand US dollar trade. This was also a difficult trade because it was elected on the Tuesday. Short, TO3 sell signal. Look at this, Wednesday. No profit, so you didn't get an exit on close from this account. At that stage, apparent counter trend trade, and look at what you got today, $1,300. And of course, you've seen the other trade here. This is the New Zealand dollar yen trade. Very nice if you manage to, outlive the rally and reversal. Okay, Jeremy, I'm waiting another copy of video 3 as we have a tutorial this Monday. I think I'm scheduled to do that for you today, Jeremy, but I'm not sure I can get it to you in sufficient time for you to look at it over the weekend. We might need to postpone Monday so that you have a chance. You really have to have a fair chunk of time and really suck in the lesson number 3 before we go further. Daryl, Mr. Mustang Man, changed her name. She's no longer Jacinda, she's now Taxinda. And Tyson, quick question. The signals are both daily and long-term. No, the trading signals are daily, Tyson. You make money by trading the daily bars. The long-term analysis is a sort of a backdrop to flesh out the picture, to give you a understanding of where markets are and probabilities, but you make the money trading one bar at a time, and that's how we do it. Okay, Harvey Weinstein, wonder who this is, one of our mates. He wants to produce a movie about the Daniel Code. I wish you would, and bring the supporting cast as well, mate. We might have a laugh, if nothing else. These days, with all the scandals going on, I guess it's more likely to be nothing else. There we are. Okay, great to have you with us today, folks. And look, we've actually got through all this and finished on time for a change. I do hope that you, Chris Amon, trying to reach Terry, DC Library available with DC Basic subscription. Looks like DC. You're doing a tutorial, Chris, so everything's available to you. Shoot me an email, I'll get it followed up. Sage was trading. This is Daryl. Sage was trading all the way up to Taupo on the car last night. Yeah, she's Sage, I think, is probably the only trader I know who's, dare I say it, more obsessed with markets than I am. She's very, very good. She was the third person I ever trained, and she made heaps of money. Love it. Daryl was the second person I ever taught to trade, and Sage was the third. And she'd never seen a chart before she came to me, one of our very best traders. Well done. And I guess you're in Taupo now. Folks, enjoy it. I wish I was there with you. Akshay wants me to have a look at the US dollar index. We can certainly do that. So this is the index itself, actually, rather than the futures contract. Will tell us the same thing. And this has basically been in a huge long-term downtrend for a very, very long time. Okay, have a look at this. Here we are. All right. So this has been in a downtrend since. Here's the consolidation across the top. December the 15th, breakout back in. Went to January the 3rd, of 2 half-week consolidation. Then it starts to trend. This is a good trading market, down and up and down and up. As it's gone down, it's this huge downtrend. As it's gone down, the rallies have got weaker and weaker. Look, there's a big rally there. This is a not bad rally. This is a feeble 4-day rally. This is a feeble 3-day rally. This is a 2-day rally with a few inside bars thrown in. This is a more complex rally here. This can happen to you. Remember, everything we do in trading is probabilities. So this turns out to be a 1-2, 2 days down, 1-2 days up. This is a multiple counter trend. This is a 1-2, 3-day counter trend, then a down bar, and then another 2, maybe 3-day counter trend. So the trend there is down. Has that changed yet? Well, let's measure the greatest rally. This is pretty simple to do. This is the biggest rally on the way down, actually. There's the low. I think that's the high. We can project it from this low. And the number we're interested in is 194. There's 1. Look at this, 94.27. It's really teasing you that this trend has changed. So what it's had is it's had the biggest rally that it's had in all of this rundown. That's an overbalance in price. I don't think it's an overbalance in time, but it might be. So there's certainly a high probability. It's just enough to tease you, isn't it? It hasn't closed above that. The close above it would have told us that the trend was over. But it's certainly teasing you to consider that the trend might well be over. Okay. All right, folks, that's me for today. I hope you've enjoyed this. Hope you've learned something. I hope you're finding this alternate way of looking at overbalance of time and price interesting. And I look forward to having your company at our next webinar. And for me, it's 11:30 Friday afternoon. So I'm off the clock, folks. Enjoy your weekend. And for those of you who need to talk to me, shoot me an email, jneedham@thedanielcode.com, which I'll certainly respond to. Okay, all the best, my friends. Bye-bye for now. Thank you, Rose. Thank you, John, MSN, and Rob. Good on you, mate. No enjoyment here over Labor weekend. Oh, yeah. Stick it to him, Rob. Anyway, at least she's a pretty fair. I don't know how she shuts her mouth, honestly, with those teeth. But anyway, she shouldn't be critical of other people, especially nice high achievers. I'll be back in New Zealand hopefully sooner rather than later. So I think I've probably got to be nice to Jacinda. She is a pretty girl, certainly in the photos. And for us shallow male chauvinists, that means a lot. Okay. Good on you, Norbert. It's about time we had a talk, mate. Well time we had a talk, overtime. Okay, all the best, folks. Bye-bye for now.